This is a story about keeping up with the Joneses. The United States has led the world in building huge technology companies and attracting enormous capital. Now it's riding the crest of that wave into the revolution that is artificial intelligence, while Europe looks on with envy, or at least with a strong desire to try to catch up. Now, at the highest levels, it's trying to do something about it.
Growth has been slowing down for a long time in Europe, but we've ignored it. But now we cannot ignore it any longer. Now conditions have changed.
We need new tech champions in Europe.
The fact of the matter is 43 of the largest 50 companies in AI are US-based. Europe has one.
The quest for Europe to get into the mega tech game is one of the reasons it's now undertaking the biggest revision to its merger rules in over 20 years. And few people know more about the potential impacts for businesses and consumers than Fiona Morton, a professor at the Yale School of Management and a former chief economist at the Antitrust Division of the U.S. Department of Justice.
There's been a lot of angst in Europe over growth and the ability of Europe to stay at the technological frontier. And we've had a couple of reports, the Letta report and most recently the Draghi report, that have really hammered on that and pointed out all the issues in Europe that are holding back Europe from more growth.
Morton says the new guidelines, which were published in April and are now under review, aim to change that.
I think the complaint has been among some parties in Europe that the Commission is not favorable enough toward the mergers they would like to do. So this is explicitly laying out how do you come to us with a story for why your merger is really good, why your merger is going to increase innovation, something like that, and explicitly laying out what those factors would be and how you might go about showing them.
It's a big deal. It's a big deal because it's been 20 years since there was a revision of the guidelines, and it's a good exercise in showing the direction of where competition law is heading.
Ingrid Vandenborre is the head of Skadden Arp's European competition practice in Brussels. It's firms like hers that are navigating the changes on the front lines.
What the guidelines do is they set out also for the difficult deals, also for those that may not be so easily to get through. There's a couple of factors that are more developed. A, the Commission's going to look at efficiencies in a much more robust way. They call it the theory of benefit in the guidelines. So they're not only looking at what will the harm be to the economy of a transaction potentially, but also what will the benefits be. The second element is that they're going to look at markets on a dynamic way. The key term in the guidelines is dynamic competitive potential of a transaction. And so it's going to be forward-looking. One of the examples set out in the guidelines is to say, we're going to look at non-European companies and how they may bring product into Europe in the future, even if they're not doing that today. We're going to look to constraints that may happen in the future.
Beyond giving companies explicit leeway to argue for efficiencies or changes in the market to justify their mergers, the new guidelines specifically address the question of startups and provide ways for early investors to reap rewards for taking chances.
We all know that that's what startup companies need. When you invest, you need to know you have an exit route as well, and that's really what the guidelines are trying to do. So those are a couple areas where very concretely the guidelines set out some more robust frameworks for companies. Following also on the Draghi report that indicated investment needs confidence, right? And confidence needs to come with the knowledge that there is an exit strategy and an exit route that's possible.
So if I invent a drug and I want to sell it to a big pharma company, what are going to be the rules about which firm can purchase my startup? And there's various cutoffs according to what market share the startup has or the acquirer has and how big they are and so on. So that's very helpful for investors and founders of small companies that want to plot out their exit strategy, for example. And for innovation, same thing. If I'm going to merge with another firm and I'm going to bring forward an innovation story of benefit that because we're together we're going to have more innovation, I need to understand what the Commission wants to hear to explain that that's going to be the reason why our merger is going to be great. So I think those are perfectly useful things and should help with growth.
The new guidelines may make some deals easier, or at least more certain, but some think they could fall short in the specifics. For one thing, in giving more play in the joints, they may require additional work for companies and their lawyers. In any set of regulations, and particularly in competition, there's a balance between certainty and discretion with the regulator.
Right.
Where do these proposed regulations come out on that sort of barometer? Does it give you more certainty and more clarity, or does it increase discretion? Because in reading through them, there's a lot of discretion. There are a lot of factors put into it, the hopper.
Yes, yes. That's a very important point we've been assessing with our clients as well. There's a large efficiencies framework. It's pages and pages. I mean, this is a piece of prose. It's almost 100 pages long. Efficiencies as a core part of that, so it goes on for some while in this document. I think what is important is we'll have to see how the Commission will assess it in the first decisions to come under these guidelines, right? And to see how they will set out this framework and implement it in practice, because I would think initially it may lend itself to a bit of discretion.
And although the new guidelines would recognize the need for scale in some sectors to achieve the sort of innovation that Europe seeks, with that scale may also come greater scrutiny.
The thing that really does come through in the enforcement of mergers is when you need to be that big to participate in an industry successfully. We know there will not be hundreds of competitors. We know right up front there's going to be 1, 2, 3, 4, not that many. So we regulate with that in mind, with this oligopoly, as it's called, kind of theory in mind. And you wouldn't want, for example, Coke to merge with Pepsi. That would leave us with too few drinks choices. It's going to have the same kind of impact on mergers that have similarly few competitors. So if we only have 3 big clouds, then both conduct and mergers become scrutinized in a way that they would not if it was restaurants.
The guidelines we've seen so far are only a proposed version, with the Commission now poring over a raft of comments. But those who know suspect that the finished product won't be all that different from what we've seen, and that it will be out before the year is over.
So the consultation period ended end of last month. We know summers tend to be a quiet period. I don't know if we'll be much more ahead of Q4. What we've been told is Q4 of this year. So we may have to wait until then.
As you advise clients considering possible deals, does the proposal of these new guidelines affect timing? I mean, do you have companies saying, we better get it done now because we know what the old guidelines were, we're not sure what it's going to be? Or on the other side, do they say, you know what, maybe we could wait a little while because it may be a little bit easier to get it through?
Yeah, we've had questions like that. Or sometimes companies say, well, we'll just not look at these drafts yet because we only want to be dealing with the final product once it's there. And then we'll assess. It's kind of similar. We've said repeatedly, this is already how the Commission is analyzing mergers today. We don't think it's going to materially change whether you notify a transaction, say next week versus in November. There may be 1 or 2 decisions that will come out that will reflect efficiency assessments. That would be something to wait for. I think the private bar among practitioners, no one wants to be the guinea pig on a first efficiencies full-out assessment because it's more discretionary how that will come out and how exactly the Commission will now be applying this very robust framework.
Whatever the strengths or weaknesses in the new proposed guidelines, it will take some time to see how much they truly change what mergers make it through the European process.
I don't think these guidelines will be a sea change. I think there'll be a clarification. I think they're going to cause firms to think more carefully in a good way about, is their merger going to enhance something like resilience, innovation, help the environment in one of the ways that's credited in the guidelines, do something useful and be able to come with an affirmative story of that usefulness. That would be, of course, great, and that might encourage some beneficial mergers. But I don't think we're going to see a big change.
If we go back through history, I think it's fair to say there's been something of a dialogue back and forth between Europe regulators and US regulators when it comes to competition/antitrust. One learns from the other, one gets ahead of the other, sometimes one is proud of being ahead of the other. Will these regulations as drafted have much influence in other parts of the world, including the United States?
Well, they definitely will have influence in other parts of the world because most of the world follows Europe on competition law, not the United States. We're not that good at it, it turns out. But the thing about the United States is we redid our merger guidelines in 2023. So really, there's some learning from those 2023 guidelines that you can see in the European revision, and then some things that they're doing that go beyond what the United States did in 2023. I would say there's more on innovation, there's more on these little small firms being acquired, there's more on the theory of benefit. There's a bit less on labor and monopsony because in Europe labor regulations are so strong you don't have as big a monopsony problem.
When the dust settles, the most important question will be whether the new guidelines are fit for purpose. The purpose of keeping up with, or at least not falling further behind, the US. Or whether the thing holding the development of European tech champions back has had little to do with competition policy, but turns much more on deeper integration of the European Union itself.
The argument that they're putting forward is that that merger will make a bigger firm and therefore make some kind of European champion. That's actually not typically how we've seen the champions in other parts of the world emerge. If you think about Google or Microsoft or IBM back in the day, they didn't come from a merger. They came from very fast growth of an innovative firm. And so a lot of what the Draghi report talks about is not in fact mergers, but is about the barriers to the single market being really effective. If you start up a company in the Netherlands, how quickly can you sell across all 27 member states, 500 million people? If you could do that as fast as can happen in the United States, because we have free commerce between our states, you could grow really fast.